Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, September 24th. Jerome Powell's cautious speech yesterday poured some cold water on Fed doves and equity bulls, but the narrative of the market that the Federal Reserve just started cutting its interest rates into an improving growth outlook remains firm and supportive of risk appetite, while technology stocks continue to surf on AI optimism. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So Fed doves and risk investors didn't necessarily like Jerome Powell's cautious tone at his yesterday's speech, as the Fed chair didn't want to commit to another rate cut at next month's monetary policy meeting. He instead repeated that the risks to the jobs market in the US are still on the downside, but risks to inflation remain tilted to the upside, a mixed picture that actually does require careful monetary policy adjustment indeed. But still, note that the US 2-year yield fell yesterday and is lower again this morning in Asia, and the probability of an October rate cut from the Fed stands at 94%. So to me, the Fed and its members could hardly be sweeter for the Fed doves and equity bulls than this, considering that the US growth is expected to print a 3.3% growth in the second quarter of this year. That data is due this Thursday, and that the S&P 500 earnings growth was around 13% last quarter, double the expectations, and inflation in the US is still sticking around the 3% mark, that is more than the 2% inflation target. So in other words, the Fed has no reason to trim rates in a hurry apart from giving support to the weakening jobs market. And Jerome Powell's speech yesterday was rather encouraging for risk-taking than demoralizing in my opinion. And looking elsewhere, other Fed members also speak this week and they sound more or less dovish regarding what to do with interest rates in the coming months, with some pointing at the weakening jobs market and others assessing more importance to the potential tariff-led inflation risk that could be on the horizon or not. But we will see. On the data front, the latest PMI numbers from the US actually suggested yesterday that growth in the US business activity slowed in the month of September to lowest levels in 3 months, while prices paid by businesses for materials jumped to a 4-month high level. Now, good news here is that soft economic data is obviously supportive of further rate cuts, and that's supportive of market sentiment. But the bad news is if inflation heats up, the Fed can't cut its interest rates as quickly as desired by the markets to boost activity. But again, for now, there is nothing alarming out there. So the S&P 500 and Nasdaq 100 retreated from an all-time high level yesterday as big technology stocks led the downside correction, but the market narrative remains unchanged. The Fed just started cutting its interest rates into a resilient US economy and an above target inflation setup, and is expected to cut 2 more times this year, and that is fundamentally supportive of equity valuations. I'm repeating again because growth stocks, for example, will benefit better from the prospects of lower interest rates in the United States, given that the value of their future gains, future revenues weighs heavier for their valuations, and discounting these future revenues at lower interest rates, lower yields, makes the future revenues look higher today. It is just simple math. So yesterday's downside correction across the US markets probably doesn't hint at a broader loss of appetite in my opinion. It was just a correction, a session where there wasn't much news other than Jerome Powell's cautious speech. And what's interesting is that the CFTC data actually continues to show deep and deepening net short positions in the S&P 500 positions from institutional traders, and rate cuts could eventually help unwind a part of these positions, these short positions, and that could eventually give further support to the actual equity rally. Now, here in Europe, the PMI data yesterday came in quite mixed. So yesterday's data actually suggests that the euro area's private sector actually expanded at the fastest speed in the last 16 months. German services actually stood out yesterday, but French numbers unsurprisingly looked bleak due to the political shenanigans there. But all in all, the PMI data from Europe yesterday was better than expected by analysts and strengthened the view that the European Central Bank doesn't necessarily need to deliver another interest rate cut this year. So the euro-dollar tested but failed to clear the 118 offers yesterday. The Stoxx 600 index was slightly better bid as ASML extended gains on global AI optimism. Across the channel, well, the British PMI figures looked much weaker than expected by analysts, and the manufacturing PMI there actually warned of an accelerating contraction in the British manufacturing activity. So here as well, cable hit solid offers above the 135 psychological mark, while the euro pound does remain supported by the divergence in growth outlooks between the euro area and Britain, the first looking better than the latter. And on the index level, the FTSE 100 index remains interesting for those investors who like oil and commodities into a potential inflation heat up globally. We also have gold miners there that are interesting in this market setup, mind you, and cheaper sterling makes FTSE 100's energy and commodity giants more attractive for international investors, but I would still hedge for currency risk. Now, speaking of predictions, OECD yesterday revised its growth forecast for many major economies for this year higher, except for Germany, unfortunately for them. But the group still warned that the world economy still faces a major blow from Donald Trump's trade war. As a result, they actually revised their growth expectations for next year lower, and that's especially true for the euro area and India. Elsewhere, the Japanese manufacturing shrank the most in 6 months, and Australian inflation hit a 13-month high. Unsurprisingly really, because these numbers are reflecting the implications of the global trade war. So the dollar-yen trades very close to its 50-day moving average these days, with no convincing next direction in the short run, while the Aussie dollar benefits from the US dollar's global weakness and recovery in iron ore prices, and now from the rising price pressures in Australia that tame some of the dovish Reserve Bank of Australia expectations. Now, what's funny in today's setup is the Chinese exports, actually faced with the US trade war and hit by the trade war, well, appear to be doing quite well, because Chinese exports actually increased by 10% to the rest of the world, reviving concerns in the rest of the world that the Chinese dumping of its products could hurt local industries. But whatever the future will look like for China and the rest of the world, China has another and a very important agenda, and it's AI. Today, Alibaba jumped more than 6% on news that they are boosting their investment in AI. But wait, there are also news suggesting that Katie Wood is going back to Alibaba for the very first time after 4 years, to say that the optimism around the Chinese AI and Chinese technology stocks is really building and in the middle of a cycle probably, and there is probably more to go. And even after this year's 120% rally, the share price of Alibaba still trades at around 40% discount compared to its 2020 peak levels. In precious metals, gold extends gains to fresh record highs, with gold bulls eyeing the $3,800 per ounce level as the next natural target. Mounting tensions for Gaza and with Russia, soft US dollar, and the positive momentum, which is gold traders' best friend, are all supportive of the yellow metal, and sentiment regarding gold remains strongly positive, and that despite the overbought market conditions of the moment. And in the energy space, crude oil rebounded at yesterday's trading session on mounting tensions between Russia and the NATO countries, and API data yesterday showed a 3.8 million barrel decline in US oil inventories last week, following last week's 3.4 million barrel fall, which is also supportive of the oil bulls. But solid resistance is seen near the $65 per barrel level still, and the short-term outlook remains range-bound within the $62 to $65 per barrel range. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.